Okay, let's unpack this. We are diving deep into the world of IRAs, your individual retirement arrangements.
Yep.
These accounts are, absolutely foundational for retirement savings, right? They offer powerful tax
They
advantages.
really do.
But let's be honest, the rules, the limits, all the exceptions, it can feel like trying to navigate a real maze sometimes.
Oh, absolutely. It's complex. And we've got, a stack of material here, articles, notes, research,
Right.
covering everything from the basics, like the core differences between account types, to some really specific exceptions for getting your money out.
Uh-huh.
And those big changes from recent laws, like the Secure 2.0 Act, that one really shook things up.
It really did. So our mission in this deep dive really is to cut through that complexity for you.
Yeah.
Pull out the most important nuggets, highlight the key updates you really need to know for 2024, and, looking ahead.
Make it make sense.
Exactly. Make sure you feel better equipped to understand and, well, manage your own retirement savings.
And why should you care? I mean, it seems obvious, but mastering these rules isn't just about, like, ticking boxes or avoiding mistakes.
No.
It's really about maximizing the growth potential,
Right.
using those tax advantages effectively.
It's about knowing how to get the contributions right.
How to handle rollovers, what happens when life throws you a curveball.
Right, and crucially, how to access your funds if you truly need them unexpectedly without getting slammed by costly penalties.
Exactly. That peace of mind is huge.
That makes sense. It's about feeling confident navigating this landscape. So let's start with the bedrock then. Traditional versus Roth IRAs. This is the most fundamental distinction, wouldn't you say?
It really is. And the core difference, it just boils down to when your money gets taxed.
Okay.
So with a traditional IRA, the big potential upside is that your contributions are often tax deductible going in.
Pre-tax money.
Pre-tax money, exactly. You get a potential tax break now.
Yeah.
And your money grows tax deferred,
Okay. Deferred, meaning?
meaning you don't pay taxes on the growth each year. The flip side, though, is that generally when you take distributions in retirement, those are taxed as ordinary income.
Got it. So tax break up front, taxes later, and the Roth. How's that different?
The Roth is essentially the reverse.
Yep.
You contribute money after taxes have already been taken out,
Okay. After tax dollars.
after tax dollars. But the magic of the Roth is that your money still grows tax-free.
Nice.
And then, this is the key part, qualified withdrawals of both your contributions and any earnings in retirement are completely tax-free.
Ah, that's the dream, isn't it? Tax-free growth and tax-free withdrawals later on.
It's a powerful combination.
But that traditional IRA deduction, it isn't guaranteed for everyone, is it? It sort of depends.
Exactly. Whether you can deduct those traditional IRA contributions depends on a few things: your income level, your tax filing status,
Right.
and, importantly, whether you or your spouse are covered by a retirement plan at work, like a 401k.
Ah, the workplace plan coverage?
Yeah, if you are covered by a plan at work, there are income limits where that deduction starts to phase out and eventually disappears completely.
Okay. And what if you make traditional contributions that you can't deduct? Say your income's too high, or you just choose not to deduct. There's something critical you have to do then, right?
Absolutely crucial. If you make what's called a non-deductible contribution to a traditional IRA,
Okay.
you must report it to the IRS.
Yeah.
There's a specific tax form, Form 8606.
Form A606, got it.
Think of Form 8606 as keeping like a running tally of the money you put into your traditional IRA that you didn't get a tax break for. This is your basis.
Your basis. Why is that so important?
Because when you eventually take money out of that traditional IRA, this basis portion comes out tax-free.
Ah.
If you don't file Form 8606 and track this basis properly, the IRS essentially assumes all the money in your traditional IRA was pre-tax.
And they'll try to tax all of it when it comes out.
They will try to tax all of your withdrawals in retirement, even the part you already paid tax on. So, yeah, don't lose track of that form.
Okay. Message received. Form 8606 is your friend if you make non-deductible traditional contributions. Now, shifting gears back to Roths. Are there income limits for contributing directly to a Roth?
Yes, there are. For making direct contributions, putting new money into a Roth IRA, there are income limits based on your modified adjusted gross income.
Okay.
If your income is above a certain threshold, you might not be able to contribute the full amount, or maybe not at all.
There's a workaround, isn't there, for conversions?
Well, it's not exactly a workaround, but a different path. There's no income limit if you want to convert money from a traditional IRA or maybe an old 401k into a Roth IRA.
Ah, that's the key distinction. Income limits apply to putting new money in directly.
Right.
But no income limit stops you from moving existing pre-tax money into a Roth, though you'll owe tax on that pre-tax amount when you do the conversion, correct?
Precisely. The conversion itself is a taxable event for the pre-tax portion.
Makes sense. Okay, let's talk numbers. 2024. What are the contribution limits this year?
For 2024, the maximum you can contribute across all your IRAs, whether it's traditional, Roth, or a mix, is $7,000.
$7,000. And for those of us age 50 or older, there's a little extra room.
Yep, the catch-up contribution. If you're age 50 or over by the end of the year, you can contribute an additional $1,000 in 2024.
So that brings the total potential contribution to $8,000.
$8,000 total, correct. And Secure 2.0 actually made a tweak here for the future. Starting in later years, that $1,000 catch-up amount will actually be indexed for inflation.
Yo, interesting. So it could go up over time.
It could, which is a nice potential boost down the line.
Okay, $7,000 or $8,000 of 50 plus. Now, you can't just contribute based on, say, investment income. You need qualifying compensation, right? What does that actually mean?
Generally, yeah, it has to be earned income. So think wages, salaries, tips, bonuses,
Okay.
professional fees, net earnings from self-employment if you run your own business.
What about alimony?
Taxable alimony and separate maintenance payments received generally count.
Generally count. Are there any, surprises in what counts? Anything new?
Yes. This is one of those Secure 2.0 details that's really interesting. Certain difficulty of care payments.
The difficulty of care?
Yeah, these are payments often received by home health care providers. Secure 2.0 clarified that these can now be treated as qualifying compensation for IRA contribution purposes,
Okay.
even if those payments are otherwise considered tax-free income.
Wow, okay. So that opens the door for a group who might not have qualified before.
Exactly. It's quite specific, but very impactful for those individuals.
So what kind of income definitely doesn't count then?
Things that typically do not count include child support,
Right.
alimony received that's not taxable under current rules,
Yeah.
passive income like interest, dividends, capital gains from investments,
Got it.
pension or annuity income, and unemployment benefits. Those generally don't count.
What about married couples? If one spouse doesn't work outside the home or maybe has very low earnings, can they still have an IRA?
Absolutely. This is the spousal IRA rule. It's a great feature. IRAs themselves are always individual accounts.
Mm-hmm.
You can't have a joint IRA.
Right. One name per account.
But if you're married and file your taxes jointly, and one spouse has enough qualifying compensation, you can contribute to an IRA for the spouse who has little or no compensation.
Oh, okay. How much?
Well, you can each contribute up to the annual limit, $7,000 or $8,000 each for 2024, as long as the contributing spouse's compensation covers the total contributions for both of you.
So the working spouse's income essentially funds both accounts up to their combined earnings limit.
That's the idea. Each needs their own separate account, though.
Got it. What if someone is self-employed and their business actually shows a loss for the year? Does that kill their ability to contribute?
It depends. If your only source of income is from that self-employment activity and it resulted in a net loss,
Yeah.
then you generally wouldn't have qualifying compensation for that year, so no IRA contribution.
Okay.
However, if you also had, say, wages from a part-time job, that self-employment loss doesn't wipe out those wages when figuring out your total qualifying compensation. You'd base your contribution limit on the wages in that case.
Good distinction. It's based on the net positive compensation. So, what if someone messes up, they contribute too much, maybe more than the limit or more than their compensation allowed?
Yeah, that's called an excess contribution, and it comes with a penalty. It's a 6% excise tax. And that tax applies each year. The excess amount remains in the account.
Ouch, 6% per year. That adds up. Can you fix it?
Yes, thankfully. The key is to catch it relatively quickly. If you realize you've over-contributed, you can withdraw the excess amount.
Just the excess.
Well, the excess contribution plus any earnings attributable to that excess amount.
Ah, the earnings too. Okay.
And you need to do this withdrawal before your tax filing deadline for that year, including any extensions you get.
And if you make that correction by the deadline,
Then you generally avoid that 6% penalty on the excess contribution itself.
okay.
Now, Any earnings you withdraw might still be taxable income in the year you contributed,
Right.
and could potentially be subject to the 10% early withdrawal penalty if you're under 59.5.
Okay, so fix it fast, pull out the excess and the earnings. What if you don't fix it in time and you owe that 6% penalty? Is there a form for that?
Yes, there is.
Yeah.
Form 5329, additional taxes on qualified plans, including IRAs, and other tax-favored accounts.
Form 5329 again. That seems to be the go-to for penalties and exceptions.
It handles various penalties, including the excess contribution tax and the early withdrawal penalty, and it's also where you claim exceptions to that early withdrawal penalty.
Let's talk more about penalties and, maybe more positively, the exceptions. There have been some pretty significant new ways to get money out of an IRA penalty-free, haven't there? Thanks to laws like Secure 2.0.
Yes, absolutely. Congress has definitely recognized that sometimes life happens and people need access to those retirement funds before retirement age. These new exceptions are quite helpful.
One big one relates to natural disasters, right?
That's right. Secure 2.0 actually created a permanent, penalty-free withdrawal option for people impacted by federally declared disasters.
Permanent, okay.
Yeah. You can withdraw up to $22,000 per participant per disaster. And what's really impactful is that this relief was made retroactive.
Retroactive.
To when? To major FEMA-declared disasters declared on or after January 26, 2021.
Wow, okay.
And there's more flexibility. You actually have up to 3 years to recontribute that money back into your account.
Oh.
And those recontributions are treated favorably, essentially like a rollover, so they don't count against your normal contribution limits. You'd report these disaster distributions and recontributions on Form 8915F.
That's huge for people recovering from disasters. What about giving to charity? You mentioned QCDs earlier, qualified charitable distributions. The limit went up there too.
It did. For 2024, if you are age 70 and a half or older, you can transfer up to $105,000 directly from your IRA to a qualified charity.
$105,000.
And that amount is excluded from your taxable income. Plus, it counts towards satisfying your required minimum distribution or RMD if you're subject to those.
Good deal. And that limit's increasing again.
Yes, it's indexed for inflation now, too. For 2025, it's projected to be $108,000.
Okay. And there's a newer penalty exception, I think, from maybe even more recent legislation for smaller sort of everyday emergencies.
Yes, this one just started in 2024. It falls under the Federal Tax Disaster Relief Act of 2023, actually.
Okay.
You can now take one penalty-free withdrawal per calendar year of up to $1,000 from your IRA.
$1,000 for what kind of things?
For certain unexpected personal or family emergency expenses, think like a sudden car repair, an unforeseen medical bill, things like that.
So a little safety valve without the 10% penalty hit.
Exactly. Just one per year, up to $1,000.
There's also a new exception specifically aimed at helping victims of domestic abuse.
Correct. Secure 2.0 added this important provision. Victims of domestic abuse can now withdraw the lesser of $10,000 or 50% of their IRA account balance, free from that 10% early withdrawal penalty.
Another specific rule addressing really difficult life situations.
Yeah.
And this next one generated a lot of buzz, especially among parents and students. Using leftover 529 college savings funds for retirement. Tell us about that.
Yeah, this was big news. Starting in 2024, thanks to Secure 2.0, you can now make direct trustee-to-trustee transfers of unused funds from a 529 plan into the Roth IRA of the 529 plan's beneficiary.
So money saved for college that wasn't needed can become retirement savings. Tax-free.
Tax-free and penalty-free, yes. But there are definitely rules.
Always rules. Like what
Well, the 529 account must generally have been open for at least 15 years.
15 years, okay.
The amount you can transfer in any given year is subject to the annual Roth IRA contribution limit for that year.
So the $7,000 or $8,000 limit applies.
Right, minus any regular IRA contributions the beneficiary also makes. And there's a lifetime maximum transfer limit per beneficiary of $35,000.
$35,000 lifetime cap. Still, that's a fantastic option for repurposing those funds.
It really is. It offers a great new pathway for education savings that aren't needed for school to get a second life as tax-free retirement savings.
Definitely a game changer for how people might think about 529s. Let's shift gears to later in life. RMDs required minimum distributions. The age when you have to start taking money out, that changed again, didn't it?
It did, yes. Secure 2.0 pushed the RMD age back again. It went from 72 to 73 starting in 2023.
Okay, so age 73 now.
For now. And looking ahead, it's scheduled to increase again up to age 75 starting in the year 2033.
75 in 2033. Okay, so it's gradually moving later. Are these permanent changes?
As permanent as tax law gets, yes. These are statutory changes to the RMD starting age.
And if you miss taking an RMD, the penalty used to be brutal, right? 50%?
Oh, it was incredibly steep. A 50% excise tax on the amount you should have taken but didn't?
Ouch. Did that change too?
Yes, thankfully. Secure 2.0 significantly reduced that penalty. Effective starting in 2023, the penalty is now 25%.
25% is still high, but better than 50%.
Definitely better. And there's more good news. If you realize the error and take the misdistribution relatively quickly within what the IRS considers a timely manner, that penalty can be further reduced to just 10%.
Okay, 10% if you correct it promptly. Much less punishing, though obviously still something you want to avoid altogether.
Absolutely. Stay on top of those RMDs.
One last penalty exception, Secure 2.0 added for individuals dealing with terminal illness.
Yes, that's another important one. Recognizing the difficult circumstances, distributions made to someone who has been certified by a physician as having a terminal illness are now exempt from that 10% early withdrawal penalty.
That makes a lot of sense. Okay, so we've covered contributions, getting them right, and a whole host of specific penalty exceptions. Let's talk about distributions more broadly now. What's the general rule for taking money out of a traditional IRA before you hit age 59 and a half?
The general rule is twofold. First, withdrawals from a traditional IRA are almost always taxable as ordinary income.
Okay, taxable.
Unless it's a return of your non-deductible basis that you tracked with Form 8606, or a qualified charitable distribution, or a rollover.
Right, so usually taxable. And the second part?
And if you take that withdrawal before you reach age 59 and a half, it's generally subject to an additional 10% tax penalty on top of the regular income tax.
The early withdrawal penalty.
Exactly. The whole point is to discourage using these long-term retirement savings for short-term spending.
Right, keep it there for retirement. How are Roth IRA distributions different then? They seem more flexible.
They are. Especially regarding your contributions. You can withdraw the money you contributed to a Roth IRA.
The principal amount.
Right. Your basis, the contributions at any time, for any reason, at any age, completely tax-free and penalty-free.
Why is that?
Because you already paid tax on that money before it went into the Roth. It's after-tax money.
Got it. So your original Roth contributions are always accessible, tax, and penalty-free. What about the earnings in the Roth? The growth?
The earnings are where the rules get a bit more specific. The earnings in a Roth IRA can also be withdrawn tax-free and penalty-free, but only if the withdrawal is considered qualified.
Qualified? What makes a Roth withdrawal qualified?
Generally, two main conditions have to be met. First, you have to be age 59 and a half or older when you take the withdrawal.
Age 59 and a half. And second?
Second, at least 5 years must have passed since January 1st of the year you made your very first contribution to any Roth IRA. It's often called the 5-year rule.
The 5-year rule. Okay, so age 59 and a half and the 5-year rule met equals qualified, tax-free, penalty-free earnings withdrawal.
That's the general rule for qualified withdrawal. There are also some other ways withdrawals can be qualified before 59 and a half, like due to death or permanent disability.
Got it. Contributions, always easy access. Earnings need age 59.5, and the 5-year clock for the full tax and penalty break. Now, you mentioned that 10% early withdrawal penalty applies before 59.5 to traditional IRAs and also to non-qualified Roth earnings.
All right.
We listed some of the new penalty exceptions from recent laws, but there's a longer list of exceptions that have been around for a while, correct? And you claim these on Form 5329.
Yes, exactly. Form 5329 is where you tell the IRS, hey, I took an early distribution, but here's why the 10% penalty doesn't apply. Well, we probably don't need to list every single one.
No, probably not.
It's definitely helpful for people to know that exceptions exist for many common and sometimes challenging life events.
What are some of the big ones people should just generally be aware of?
Well, beyond the new disaster, emergency personal expense, and domestic abuse ones we already covered,
Uh-huh.
other really notable exceptions include withdrawals used for qualified higher education expenses for you, your spouse, kids, grandkids.
Okay, education.
Distributions used for buying, building, or rebuilding a first home. There's a $10,000 lifetime limit per person on that one.
First home, $10 K limit. Got it.
Withdrawals needed to pay for unreimbursed medical expenses, but only the amount that exceeds 7.5% of your adjusted gross income.
Medical expenses above a threshold.
Distributions taken because of death or permanent disability. That's a major one.
Right.
Withdrawals made if you become unemployed and need the money to pay for health insurance premiums.
Health insurance when unemployed.
Taking money out as part of a series of substantially equal periodic payments, often called SEPPs or 72T payments.
Yeah.
That's a way to tap the IRA early over time.
SEPs, okay.
Money taken due to an IRS levy against your IRA.
If the IRS takes it, no penalty. Makes sense.
If you're a qualified military reservist called to active duty and the qualified birth or adoption expense exception, you can take out up to $5,000 per child, penalty-free, near the time of birth or adoption.
Wow, okay. That's quite a list. It really shows there's a safety net built in for various significant life needs, even if you have to pay income tax.
Exactly. The goal isn't to lock the money away completely and flexibly, but to ensure it's primarily used for retirement unless one of these specific needs arises.
Now back to RMDs for a second, just to be crystal clear for everyone listening. Traditional IRAs require the original owner to take RMDs eventually,
Correct.
but Roth IRAs do not require the owner to take RMDs during their lifetime.
That is absolutely correct.
Okay.
Owners of traditional IRAs, SEP IRAs, simple IRAs must start taking distributions once they reach the RMD age, which is currently 73.
Okay.
Roth IRA owners, however, are never required to take RMDs from their own Roth IRA during their lifetime.
So the money in a Roth can just keep growing tax-free indefinitely for the owner?
Exactly. That's a major advantage of the Roth structure during the owner's life. RMD rules only kick in for a Roth IRA after the original owner passes away and it's inherited.
Okay. And the timing for that very first RMD from a traditional IRA, once you hit age 73, is it due right away?
You actually get a little grace period for the very first one. Your first RMD is technically for the year you turn 73. You can delay taking it until April 1st of the following year.
April 1st of the year after you turn 73.
Right. However, there's a catch. If you delay that first RMD until the following year, you'll then have to take 2 RMDs in that second year. You have to take the delayed first one by April 1st, and you have to take the RMD for the current year, the year you turn 74, by December 31st.
2 RMDs in one tax year, that could bump up your income significantly.
It definitely could. So most financial advisors suggest taking your first RMD in the year you actually turn 73 just to avoid that potential income spike. All subsequent RMDs must be taken by December 31st of each year.
Okay, makes sense. Take the first one in the year you turn 73, then one each year by December 31st. Let's quickly revisit those qualified charitable distributions, QCDs. How exactly do they interact with RMDs again?
Okay, so if you're age 70 and a half or older.
70 and a half for QCDs, even though RMDs start later?
Right, the QCD age didn't change. If you're 70.5 plus way, you can instruct your traditional IRA custodian to send a distribution directly to a qualified public charity.
Directly to the charity.
Correct. And the beauty is the amount transferred via QCD is excluded from your gross income for tax purposes.
Excluded, not deducted.
Exactly.
Yeah.
This is generally better than taking the RMD, recognizing it as income, and then taking a charitable deduction, especially because it lowers your adjusted gross income, AGI.
And lowering AGI can help with other things.
Yes, like potentially reducing Medicare, Part B and D premiums, or minimizing taxes on Social Security benefits.
And does the QCD amount count towards satisfying your RMD for the year?
It absolutely does, up to the amount of your RMD and up to the annual QCD limit, $105,000 for 2024.
Okay. But you can't double dip, right? Exclude it from income A and D, claim a deduction.
No, definitely not.
Yeah.
Because it's excluded from income, you cannot also claim it as an itemized charitable deduction on Schedule A. That would be double dipping.
Makes sense. What about doing a QCD from a Roth IRA? You mentioned it earlier, but just to clarify.
You can technically instruct your Roth IRA custodian to send money to a charity.
But
There's really no tax advantage in doing so.
Right.
Since qualified Roth distributions are already tax-free.
Right.
Excluding that distribution from income via the QCD rules doesn't give you any extra benefit. QCDs are really designed as a tax-efficient strategy for satisfying RMDs from traditional IRAs where the distributions would otherwise be taxable.
Got it. Traditional IRA strategy primarily. Now, what was that about a recapture rule if someone made deductible contributions after age 70 and a half? That sounds specific.
It is pretty specific. Before Secure 1.0 allowed people to contribute to traditional IRAs past age 70.5, this wasn't an issue. But now, if you did make tax-deductible contributions to your traditional IRA for years after you turn 70 and a half,
Okay.
there's a rule that essentially reduces the amount of your future QCDs that can be excluded from income.
Reduces the QCD exclusion.
Mm.
By how much?
By the total amount of those post-age 70.5 deductible contributions you made. The idea is to prevent you from getting a tax deduction when the money went in and a tax exclusion when it comes out via QCD for the same dollars.
Okay, so it claws back the benefit on those specific contributions. Complex, but important for that group who contributed deductibly after 70.5. Now, all of these distributions we're talking about, RMDs, QCDs, regular withdrawals, they get reported somewhere, right? How does the IRS know?
Yes. Anytime you take a distribution or have money moved out of your IRA for almost any reason, if it's $10 or more, the IRA custodian or trustee is required to issue both you and the IRS a Form 1099-R. Distributions from pensions, annuities, retirement or profit-sharing plans, IRAs, insurance contracts, etc.
Form 1099-R, that's the one you get in January, February.
Exactly. It shows the gross distribution amount, the taxable amount, if known by the custodian, and codes that indicate the type of distribution and whether any known penalty exceptions might apply. You use this form when you file your taxes.
Okay. Let's talk about moving money between retirement accounts. Rollovers. This seems like it should be simple, but I hear it trips people up sometimes. What's the main difference between an indirect and a direct rollover?
Big difference, and direct is usually the way to go if possible. A direct rollover is also called a trustee-to-trustee transfer.
Okay.
The money goes straight from the financial institution holding your old retirement account directly to the financial institution that will hold your new one.
You never actually touch the money.
You never touch it. It just moves from custodian A to custodian B. There's generally no tax withholding, and importantly, there's no limit on how many direct rollovers or transfers you can do in a year.
Okay, direct sounds clean and simple. What's the indirect rollover then?
With an indirect rollover, the money is actually paid to you first. The custodian of the old account cuts you a check or deposits it in your bank account.
Okay, I have money. Now what?
Now you have a strict 60-day window from the day you receive the funds to deposit that money into the new retirement account, like another IRA or maybe a 401k.
Only 60 days. What happens if you miss that deadline?
If you miss the 60-day deadline, the entire amount you received is generally treated as a taxable distribution.
Taxable.
And if you're under age 59 and a half, it would likely be subject to that 10% early withdrawal penalty as well. So missing the deadline can be very costly.
Definitely want to avoid that. Is there another catch with indirect rollovers, specifically involving IRAs?
Yes, this is a really critical rule that catches a lot of people off guard. You are only allowed to make one indirect rollover from an IRA to another IRA within any 12-month period.
One per 12 months. Does that mean one per IRA account?
No, that's the tricky part. It's one for 12 months aggregated across all of your IRAs. So if you take an indirect rollover distribution from IRA and deposit it into IRA B within 60 days, you cannot then do another indirect rollover involving any of your other IRAs, say from IRA C to IRA D or even back from B to A, for a full 12 months following the date you received the funds from that first indirect rollover.
Wow, okay, that's restrictive. One indirect IRA to IRA rollover in any 12-month period.
Exactly. It applies to the movement of money received by you.
What about rolling money over from an old 401k or another employer plan? Does the 60-day rule apply? And is there anything else to watch out for?
The 60-day rule definitely applies if you do an indirect rollover from an employer plan.
Yeah.
But there's another big thing with employer plans. Mandatory withholding.
Withholding.
Yes. If you choose to receive the distribution from your 401k or a similar plan directly as an indirect rollover, the plan administrator is required by law to withhold 20% of the amount for federal income tax.
20%. So I only get 80% of my money.
You receive 80% in cash.
Yeah.
But if you want to roll over the full 100% balance to keep it growing tax deferred in an IRA, you have to come up with that missing 20% from your own pocket from other savings and add it to the 80% you received, depositing the full 100% into the new IRA within the 60 days.
Oof. So I have to temporarily front the tax money. Do I get that 20% back?
Yes, you'll eventually get the 20% that was withheld back when you file your tax return for that year, likely as a refund or a credit against taxes owed. But you have to make up the difference in the meantime to complete a full rollover.
That seems like a major hassle and a reason to strongly prefer
A direct rollover from the employer plan to your IRA.
Exactly. With the direct rollover, no 20% withholding, no 60-day deadline stress.
Correct. Much simpler and safer.
Just to clarify one last thing on the rollover limits, that 1 per 12-month rule for indirect IRA to IRA rollovers, does that limit apply to direct trustee-to-trustee transfers between IRAs?
No, it does not. Direct transfers between IRAs where you never touch the money are unlimited.
Okay. And what about converting a traditional IRA to a Roth IRA? Does that count against the limit?
No, conversions from traditional to Roth are also not subject to the 1 per 12-month indirect rollover rule.
Good to know. Direct transfers and Roth conversions are exempt from that particular limitation. All right, let's shift to inherited IRAs. This is an area where the rules got a major overhaul a few years back with the Secure Act 1.0, right? Especially for non-spouse beneficiaries.
They absolutely did. It fundamentally changed the landscape for many people inheriting IRAs before Secure 1.0 came into effect.
Yeah.
Most beneficiaries who inherited an IRA, even non-spouses, could choose to stretch the distributions over their own life expectancy.
Stretch IRA. I remember hearing about that.
Exactly. It allowed the inherited funds to continue growing tax-deferred, sometimes for decades, with only small minimum distributions required each year. Secure 1.0 largely eliminated that stretch capability for most non-spouse beneficiaries who inherited an IRA from someone who died after December 31st, 2019.
Okay, so post-2019 deaths, what's the general rule now for most people inheriting an IRA from, say, a parent or a sibling who passed away in 2020 or later?
The new general rule is often called the 10-year rule.
The 10-year rule.
It requires that the entire balance of the inherited IRA must be fully distributed, meaning completely emptied out by the end of the 10th calendar year following the year the original account owner died.
By the end of year 10. Wow. So no more stretching for decades.
For most, no. And there are penalties.
Yeah.
That same 25% or 10% excise tax we talked about for RMDs if you fail to empty the account by that 10-year deadline.
Just to confirm, does the 10-year rule mean you have to take out like 1/10 each year, or can you wait and take it all out in year 10?
That's been a point of some confusion and evolving IRS guidance. For many beneficiaries subject to the 10-year rule, the current understanding based on proposed regulations is that there are no annual RMDs required during the 10-year period if the original owner died before their own RMD required beginning date.
Okay.
However, if the original owner died on or after their RMD required beginning date, the beneficiary might also have to take annual RMDs within that 10-year period based on their own life expectancy, in addition to emptying the account by year 10. It's complicated.
Definitely sounds complicated and maybe still settling. But the key takeaway is the account must be zero by the end of year 10 for most non-spouses inheriting post-2019.
That's the definite deadline, yes.
But there are exceptions to this 10-year rule, right, for certain types of beneficiaries.
Yes, the law carved out exceptions for a specific group called eligible designated beneficiaries, or EDBs.
EDBs. Okay.
These individuals are not subject to the 10-year rule and can still stretch distributions from the inherited IRA over their own life expectancy, similar to the old rules.
Who qualifies as an EDB? Who gets to keep the stretch?
There are 5 categories. First, the surviving spouse of the IRA owner. They always have special treatment.
Okay, surviving spouse.
Second, a minor child of the IRA owner.
Yeah.
However, the 10-year rule does kick in for them once they reach the age of majority, which is typically 18 or 21, depending on the state and plan documents.
So the stretch only lasts while they're a minor?
Generally, yes. Third, a disabled individual, based on strict IRS definitions. Fourth, a chronically ill individual, also based on definitions.
Disabled or chronically ill.
And fifth, an individual who is not more than 10 years younger than the deceased IRA owner.
Not more than 10 years younger, so like a slightly younger sibling or maybe even an older relative.
Exactly. If your sibling was, say, 5 years younger than you, and they inherited your IRA, they could likely stretch it. But if your best friend who's 20 years younger inherits, they'd probably be subject to the 10-year rule.
Okay, that 10-year age difference is a key dividing line for EDB status among non-disabled, non-minor, non-spouse beneficiaries.
Right.
And the surviving spouse, you said they have the most flexibility. What can they do?
Absolutely. Surviving spouses have the best options. They can choose to roll the inherited IRA into their own IRA. If they do that, the account is just treated as theirs, subject to their own RMD rules later on.
Okay, treat it as their own.
Or they can choose to keep it as an inherited IRA. If they do that, they can generally delay taking RMDs until the deceased spouse would have reached RMD age. Or they can take distributions based on their own single life expectancy. They have strategic choices.
Lots of options for spouses. And just to be absolutely clear, if someone inherited an IRA from someone who died before January 1st, 2020,
They are grandfathered in.
grandfathered.
Yes. Anyone who inherited an IRA before 2020 can continue to follow the old stretch IRA rules based on their life expectancy. The Secure Act changes, and the 10-year rule do not apply to them. The date of death is the critical factor.
Date of death is key. Okay. Finally, let's touch on something that hopefully doesn't happen often, but can have truly devastating consequences. Prohibited transactions and prohibited investments within an IRA. What exactly is a prohibited transaction?
Yeah, this is serious stuff. In simple terms, a prohibited transaction is an improper use of your IRA account or its assets. It involves some kind of self-dealing or transaction between the IRA and a disqualified person.
Disqualified person, who's that?
A disqualified person includes the IRA owner themselves, their spouse, their ancestors, parents, grandparents, their lineal descendants, children, grandchildren, and the spouses of those descendants.
Okay, so direct family line up and down, plus spouses.
Right. Interestingly, it does not usually include siblings, aunts, uncles, cousins, or friends. The definition is quite specific.
So what kind of actions involving the IRA and one of these disqualified persons would be prohibited? Give us some example.
Oh, there are quite a few. A classic one is borrowing money from your IRA. You can't do that. There's no such thing as an IRA loan.
Okay, no borrowing.
Selling property you personally own to your IRA or buying property from your IRA for personal use.
Can't buy that beach condo with your IRA funds if you plan a vacation there.
Definitely not. Using the IRA or its assets as collateral or security for a loan is also prohibited.
Pledging the IRA for a loan. Bad idea.
Very bad.
Yeah.
Also, paying yourself unreasonable compensation from the IRA for managing it, or engaging in transactions that benefit a fiduciary at the expense of the IRA. Basically, any transaction that looks like you're using the IRA for personal gain now rather than for retirement savings.
Okay, avoiding self-dealing. What happens if one of these prohibited transactions does occur? You said the consequences were potentially devastating.
They are severe. If a prohibited transaction occurs at any point during a calendar year, the entire IRA account is treated as if it ceased being an IRA on January 1st of that year.
Ceased being an IRA. What does that mean practically?
It means all the assets inside the account are treated as being distributed to the owner on that January 1st date.
Whoa, so the entire account value becomes taxable income?
The entire fair market value becomes taxable income in that year. And if the owner is under age 59 and a half, it would also be subject to the 10% early withdrawal penalty.
On the whole amount, that could completely wipe out an account with taxes and penalties.
It absolutely could. It's often called blowing up the IRA. This is why it's so critical to avoid prohibited transactions, especially for people using self-directed IRAs to hold alternative assets like real estate or private company shares, where the lines can get blurry if you're not careful.
That consequence really underscores the importance of following the rules strictly. Are there also specific types of investments that an IRA just isn't allowed to hold in the first place?
Yes. The Internal Revenue Code explicitly prohibits IRAs from investing in certain types of assets. Doing so is generally treated the same as a prohibited transaction the account blows up.
Okay, what kind of investments are off limits?
The main category is collectibles. This includes things like works of art, rugs, antiques, metals, other than certain specific bullion and coins, gems, stamps, most coins.
Most coins, even valuable ones.
Generally, yes, unless they are specific U.S. minted gold, silver, or platinum coins, or certain state minted coins, or specific types of gold, silver, platinum, or palladium bullion that meet strict fineness standards.
Okay, so some specific bullion and U.S. coins are okay, but general numismatic coins are usually out. What else?
Life insurance contracts cannot be held inside an IRA, and S-corporation stock is also generally a prohibited holding.
S-corp stock. Okay. What about real estate? You mentioned not using it personally. Can an IRA own investment real estate?
Yes, an IRA can own investment real estate, provided it's truly held for investment purposes, and doesn't involve any prohibited transactions like personal use by the owner, or a disqualified person, or improper financing. But it requires careful structuring and adherence to the rules.
That level of detail, especially around prohibited transactions and investments, is intense but clearly crucial. This whole deep dive really highlights just how much there is to know about IRAs, doesn't it? Even for something so fundamental to retirement planning.
It really does. And, the goal isn't necessarily for everyone listening to memorize every single rule, every form number.
Right.
But it's about understanding the key distinctions, traditional versus Roth, the contribution rules, how money comes out normally and in those exception cases, and being really aware of the big pitfalls like missing RMDs, or that 60-day rollover deadline, or accidentally stumbling into a prohibited transaction.
So thinking about everything we've discussed, what does this all mean? We've covered a ton of ground here in this deep dive.
We really have.
From those core tax differences between traditional and Roth IRAs, the latest contribution limits for 2024, navigating the sometimes tricky rules around rollovers.
Right, direct versus indirect, that 1 per year limit.
And understanding some really specific, often newer penalty exceptions for things like those disaster relief withdrawals, the small emergency expense option, or situations involving domestic abuse.
And we hit on those significant Secure 2.0 Act changes too. The higher RMD age, the lower RMD penalties.
Huge changes there.
That really powerful new ability to transfer unused 529 funds into a Roth IRA.
Game changer.
And the crucial updates to inherited IRA rules, which really shifted things with that 10-year rule for most non-spouse beneficiaries inheriting now.
What's really fascinating, I think, is seeing how these rules aren't just static. They keep evolving, don't they?
Constantly.
Often seems like they're responding to real-life challenges people face, or maybe trying to simplify things in some areas.
While still demanding really careful attention to detail in others, you still need to get the qualifying compensation right, avoid those prohibited transactions, file the right forms.
Absolutely. So for you, the listener, the takeaway probably isn't just memorizing the $7,000 limit or the RMD age,
No.
but really understanding the structure of these rules, maybe the underlying why behind them, and importantly, knowing when your specific situation might have nuances that mean you need to dig a little deeper, or maybe even seek professional guidance.
Well said. It's about knowing what questions to ask based on your own life circumstances.
Which leads us to a final thought, maybe something for you to mull over. How might these specific changes and exceptions we've talked about, things like the new ways to access funds penalty-free for emergencies, or the different landscape for inherited IRAs now, how might those impact the way you think about structuring your own savings, your contingency planning for unexpected life events, or even the conversations you might have with your family about things like estate planning and inheritance?